Sephora.
Ares Management is the first idea here. You thought of that LVMH brand.
Sorry, at the most inopportune time. Sephora. That's why my girls wanted to own LVMH, was Sephora.
The cosmetics.
Yes,
yeah.
So that's what it came to be. Ares Management, yes. So 2 of our 3 picks are going to be in the investment management, like where we're buying what we know. Now, Ares Management, interesting in that it is private debt.
Okay.
And kind of like, in a different way, benefiting from the current trend in banking to simplify, downsize, and not lend as much money to perhaps marginal players, mid-sized companies. Ares Management arranges the debt financing, invests in debt in the private space. Now, why does that matter? Because private equity, everyone's private equity. I want to buy this or that or the other stock and have it go IPO. And so private equity is really crowded. It's where you actually, equity being the part where you own a stake in the growth of the business. Private debt, however, is where you're lending money. It may have an equity kicker, but it's a much smaller part of most institutional portfolios. So it's a potentially big growth area with a tailwind behind it of there being more availability. When Silicon Valley Bank and the other went out of business, and when the other regional banks in the U.S. were under a lot of pressure, and of course they've been lending to some of these more growth-oriented businesses. They're out, so now private lenders have come in as opposed to bank lenders, and Ares has an ability to participate in that in a sector that's growing both as part of the institutional portfolio, where the supply and the opportunities are also growing because the banks are getting out of that space. So we think it's in the investment management business a potential leader.
Now, your family has a long history of investing in exchanges of various sorts. So CME Group, not just commodities, but derivatives, et cetera.
Yeah, so the Chicago Mercantile Exchange, CME Group, is the 800-pound gorilla, at least in North America, and probably the world in the futures space. Now, the derivatives area is more like most people think about buying and selling, they're thinking stocks.
Yes.
But stocks are fungible. You can buy a stock on one exchange and sell it on another. You and I can trade stocks between us. There's no exclusivity. What the Chicago Merc has generally is products that are exclusive. They have deals with S&P and a host of other providers to have the exclusive right to trade their indices as futures products, which are highly leveraged, and the Chicago Merc also has the custody, and there's actually quite a lot of money to be made in clearing and settlement of the futures as well. And again, they have an exclusivity there. Where the business is growing is both internationally and in terms of data. Data is the new electronic gold, and for money managers and traders, the sale of data is the currency. So CME is expanding overseas and expanding its data business. I think and the business generally is growing. So, and it also has the exclusivity. It has a high fence around it where a stock exchange might not.
It's interesting. Yeah, people are trading securities, but the information has enormous value too. And we better keep moving. W.W. Grainger, remind us what they're all about.
So they are in the business of repair, maintenance, and operating, so-called MRO. I guess if you had to think about it, they're the Amazon for the industrial space. Not that Amazon's not in that business, Amazon's in every business. But if you need supplies for your factory, for your hospital, it could be fasteners, it could be ceiling tiles, it could be anything to just keep your business, healthcare facility running. There has been a lot of consolidation. They've been able to acquire a number of businesses in this area. So it's a theme around the onshoring in America, so that as there is more and more factories and businesses being built in America, whether it's robotics, whether it's in semiconductors, companies like, and specifically W.W. Grainger, have the ability to be one of the primary suppliers in all the stuff that they need to keep their factory running.
Okay, we don't think about it maybe, but somebody's got to.
Boring is good.
Yeah.
Ryan Reynolds.
Is that what he? Yeah.
Well,
yeah.
in the Hitman's Bodyguard, he has to be one movie quote in one of our segments, otherwise they won't know it's me.
I am looking forward to Wolverine and Deadpool. I'm not a huge superhero fan, but I do like.
I think it is a comedy movie in a superhero wrapper. I think that's what it'll be.
First idea, Smith and Nephew, SNN. Remind us what they do, Lauren.
Sure. Smith & Nephew is one of the global leaders. They're out of the UK in hip and knee replacement and also wound management. Ointment that they have, Santil, which is a global leader in helping your wound close faster. It's a huge growth area. And listen, this is a great secular growth story. Smith & Nephew earnings have been weak over the last couple of years. But partly due to COVID, and there's a huge lineup of people waiting to get their hips and knees replaced. But in terms of the secular growth story, listen, we're all getting older. People want to play pickleball and golf, and so they're incredibly well positioned. Its stock is incredibly cheap. It's the lowest valuation, I think, in its last 50 years, possibly. 14 times earnings, 12 times next year's earnings, and revenues are reaccelerating again. Earnings are growing, margins are growing, 3% dividend yield. An opportune time to be in this space.
How would it compare with, say, a Stryker?
It's cheaper than Stryker, probably a little more narrowly focused as well than Stryker. And so you're really getting more of a pure play here. And like I said, and you speak to any medical professional in this field, and also at my squash club, I see more and more people with hip and knee replacements out there on the pickleball court and playing double squash. And people want to stay healthier longer, and this is it's a great area to be in.
It's amazing. All right, they're back out on the court in short order.
Incredible, incredible. People getting 2 knee replacements. A friend of mine's just had both knees replaced at the same time, believe it or not.
Whoa.
And people, the recovery rates are faster, and doctors are telling patients, the technology's improved so much just in the last decade.
Taiwan Semiconductor.
Sure. So if you want a way to play AI, Taiwan Semi is the largest chip manufacturer in the world. After a period of massive investment, and they're just finishing off a massive plant in Arizona, and getting some money from the US government, they make the chips for NVIDIA and a whole bunch of other people. And so they are by far the leader in AI chip manufacturing. We're looking at earnings to grow by 50% over the next couple of years. Stock's at 20 times earnings, it's 15 times next year's earnings, extremely cheap, and by far the best in the world. They're several years ahead of the competition, which is basically Samsung. Intel's the third largest manufacturer, but Intel's fallen by the wayside to a great degree. And so, they're the best in the business.
We're expecting NVIDIA numbers on May 22nd. That stock's still up 84% this year. Is that one that interests you?
I have to sometimes say, Andy, that we missed something rather than chasing something. That's, we need to always say, okay, if I buy it here, am I going to be able to generate the kind of return we're looking for? And with NVIDIA, there's too much risk for us. Management's been spectacular. The earnings should be great. Will they be match expectations? Who knows? But there will be, for sure, good growth there. We'd rather own Taiwan Semi. A little bit less exciting, let me say, but trading at a much more attractive valuation for us, lower risk.
Okay. And then your final idea, Universal Music Group.
The largest owner of music in the world, Beatles, Taylor Swift, Drake, and a whole slew of others, recently in the news because they took all their music off TikTok, as you may have seen. Off TikTok, because TikTok was not paying them well enough. They're by far the largest. So they've got the power. Eventually, TikTok came back to the table and renegotiated the deal, which pays Universal. You have to own music. Listen, music is, in content-wise, over 20% of Universal UMG's revenues are from music that was made over 20 years ago. And people tend to listen very much often to the same music they listen to their whole lifetimes, which is why all these concerts are so popular with, people 35 years later. And so massive free cash flow, best in the business. For us, the stock price is just take the price of the existing catalog. Music is growing in streaming, it's growing in video games, it's growing in health and fitness. All of these areas are having to pay Universal Music a little tiny piece of the music of each time they play a song. And you've seen the artists sell their catalogs for hundreds of millions of dollars. Universal owns the other part of that catalog, which gives you some idea of the scale and value of what is in this company. So we're looking for, revenues to grow by 10% a year, but higher margins and faster earnings growth. They're already generating free cash flow. I mean, for us, this is an absolute core holding. And there's nothing like it in the world.
First idea, Dollar Tree. Some of the dollar stores in the States have been suffering, but you think this one offers promise?
So Dollar Tree, a bit of a unique story. So as you did mention, the dollar stores in the U.S. are suffering a little bit. So the lower income consumer, I think we talked about a little earlier in the United States. We've seen the discount retailers talk about this. We've seen the Starbucks of the world, McDonald's of the world talk about this. They're starting to pull back some of their purchases. They're not spending at the same rate they were previously. And that, as a result, you can see some of the more recent pullback in Dollar Tree stock here. That's what's contributed to that. Longer term, though, we think Dollar Tree occupies a very good niche in the U.S. market. That's them and Dollar General are the two biggest competitors for the very low-cost dollar store market. Dollar Tree we like because it's in the midst of a multi-year change in strategy. So this started, I think, 2.5 years ago. An activist investor came in, management team changed, and they adopted the playbook that we saw here from Dollarama in Canada, where multiple price points were introduced to people that were shopping at their stores. Previously at Dollar Tree, it was $1. Basically, anything that they sold was $1, but that limited the merchandise that they could put on the shelves. So Dollarama implemented the strategy back in 2009, worked very, very well for them, saw margins, free cash flow expand considerably. It's been a bit of an uneven path for Dollar Tree down this line, but it has been generally working well. More recently, in addition to the Dollar Tree banner that they own, they also own Family Dollar. So that has been struggling a little bit in the U.S. And they said all options are on the table with respect to maybe consolidating some of the locations they have, cutting costs there. There have been a number of underperforming Family Dollar stores. So we like what management's doing. We like that they're open to changing things up. And we think that Dollar Tree does have a good niche that they can benefit from going forward.
Next idea, Zoetis, the animal health player.
Yeah, so a pharmaceutical company, but for animals. So about 2/3 of the products go to pets, and about 1/3 goes to livestock. So we talked about Merck earlier and their R&D pipeline. A lot less costly to develop pharmaceuticals for animals. The testing requirements from the FDA aren't as high. The time to market is a lot lower. And there isn't as much competition from generics out there as well, too. So Zoetis, I think, in its key species verticals, occupies something like 90% share in the actual animal species that it targets. So parasiticides is a good product it puts out there. There's been some overhang recently. You see a little bit of the pullback in the shares there. A painkiller that it provides for companion animals, for pets. There was an article in one of the major U.S. papers with some anecdotal evidence that there were some negative outcomes from pets that were on this painkiller that Zoetis was providing. In our view, that was purely anecdote, and it doesn't align with the actual data that's out there to support the effectiveness of these drugs. So we like the niche Zoetis is in. We think it has good growth products going forward. Of course, with COVID, it seems like everybody got a pet, so they want to maximize the lives of those pets. And we think Zoetis is in a good spot to capitalize.
TE Connectivity, just an industrial company that helps keep our society running with electrical fasteners.
It does. It sounds like a very boring company. And I sort of alluded to it earlier when we were talking about Magna. This is our entry into sort of the car market. So TE Connectivity makes a lot of the connectors you see in internal combustion engines, but there's even more content when you get into the hybrids, which have more electronics, even more when you move into full-on electric vehicles. I think it's 2 times the amount of content TE has in a vehicle. So with that ongoing shift away from internal combustion engines into more electrified vehicles, and of course, more sophisticated vehicles have more sensors too, that TE has more products in. We like our exposure to the sector that way, as opposed to us having to go in and pick a specific manufacturer, a Toyota of the world, and think they're gonna benefit from a shift in car technology going forward. In addition, TE also makes connectors for data centers, and it's seeing substantial growth there recently with the AI craze that we're seeing and cloud computing craze. So more and more data centers, high-speed data centers being built. TE makes very highly engineered connectors for those data centers, and it expects some pretty substantial growth from that side of things going forward.
Yeah, it's interesting, the stock, given that a big part of their business is the auto industry, it's interesting how well the stock has held up.
Exactly, yeah. I think it's the growth from the AI side that people are really fixating on now. I mean, in terms of percentage profits, it's a pretty low contributor to overall consolidated earnings, but people are optimistic about what's going to happen there.
All right, now it is time for the top picks from Mike Vinegar with IA Private Wealth, and we're starting a little defensive. Johnson & Johnson.
Yeah, so this is in part with our view of maybe we want to take a little bit money off the table, seasonality, sell in May, go away type thing. What's working, what's catching a bid? So we've noticed in the last little while that telecoms, pipelines, healthcare is catching a bid. Why? Because it's solid, because they've got great balance sheets. In the case of Johnson & Johnson, you've got a storied brand that has been around for forever, really. Yeah. They did the spin-off, I think it was last year, into Kenvue of some of the lower margin businesses. And so today you've got Johnson & Johnson, which has a great dividend yield, and they've got some wonderful drugs and some med tech. They've got a huge pipeline of new products that they're going to be, pushing out into the market. They've come onto the airwaves to say, we're reaffirming our target of 10 and change dollars of earnings. We think those earnings can grow at, a 5 to 10% clip. So, buying something like this with such a brand power, such a great dividend yield at a 14 and change multiple is not expensive and great for this time of the year. Another defensive pick, you're nipping away. We've talked about this in the past, but the telecoms, and your pick today is Rogers. Yeah. I was very impressed with Rogers' execution. The stock has dropped, like all telecoms, quite a bit. However, if you look at their forward guidance on free cash flow is fantastic. They're guiding, I think, a pickup of 20% in free cash flow. And if you look at the valuation, last time I checked, when we bought the stock just a week or so ago, I think we paid less than 9.5 times forward free cash flow. So, they did the Shaw acquisition. They have realized the synergies ahead of time. Yes, they took on a lot of debt, but they are really making lots of strides to push that debt down. By the end of this year, I believe it's going to be 4.2 times leveraged, which sounds like a lot, but really, they're the casino, right? They have the monopoly money, the license to print money, right? They're one of the three big ones. And so we really like their execution. They're the number one leader now in cable in Canada, number one in wireless. They've got 5G networks coast to coast. And the dividend yield may not be as high as the parent of this network. Yes, PCE. Having said that, we think that dividend is very stable, and we really like the valuation. And so are you only selecting Rogers in a telecom approach, or are you? Yes. Yeah, okay, yes. All right, well, I asked. So defensive picks with Johnson & Johnson and Rogers, and then maybe a sprinkle of cyclicality with FedEx? Yes, well, so FedEx is typically a cyclical business, but we think what's happened here that's of note most recently is you've had two major trucking companies go bankrupt, and those were big ones. One is Yellow, and the second one is Pride. And who knows how many more smaller trucking companies. Now, with the advent of reshoring to North America, you have to believe that the demand for trucking, whether it's less than load, whether it's full load, as a mode of transportation is going to be increased. The other thing is, with the big accident with the barge, in Maryland, that stopped a lot of maritime traffic, which more than likely increased the demand, at least temporarily, on rail and trucking. We love FedEx's management. They've got a $5 billion plus buyback, which is meaningful in the grand scheme of things of their market cap. They've guided to 17 and change earnings this year, and we think that can jump easily to into the 20s by next year based on them achieving more of their cost initiatives and accelerating the buyback. So you're not paying a lot for what we think is the best operator in the business worldwide. It's got a decent dividend yield and not a huge valuation.
So this is an interesting play on that broader trucking trend. Would you buy some of the other truck, like a JB Hunt or something?
We haven't looked at trucking per se.
Okay.
Remember that FedEx is not specifically trucking.
That's right.
Right? They're trucking, they're overnight
That's why
delivery.
I was wondering, would you go and if part of your thesis is those other failures, would you go right into some of the competitors?
We haven't looked at JB Hunt yet. We think that business is a little bit more cyclical than the FedEx business, and we like the FedEx business because it's got so much of the international business as well, which arguably is growing faster than the domestic business or the domestic economy here.
First idea, TC Energy.
That's right, Andrew. This is a company we own in our dividend growers mandate. The yield is very juicy, 7.4%. We expect that dividend will grow at about 3 to 5% per year. And for those who don't know, although I suspect most do, this is the huge energy infrastructure company. Notably, they move about 25% of all the natural gas in North America from Canada, the U.S. to Mexico, and also have an oil pipeline segment, Keystone being one that's in the news quite a lot in recent years. And then apart from that, they've got a power generation unit, Bruce Power, the nuclear reactor, and some renewable energy in that segment. Stock is very cheap. It trades at about 12.5 times earnings. They've got 2 big capital projects that are going to come into service next year. That's the Coastal gas pipeline that will take gas to the LNG Canada export terminal and also Southeast Gateway in Mexico. The big catalyst is they're splitting the company in 2. South Bow Energy will hold the oil assets, and all the other assets will remain in TC Energy. That should allow these 2 different companies to migrate into the hands of their natural owners, with ESG-centric investors preferring to own the legacy company, and those that are ESG agnostic might find the cash flow from the oil pipelines at South Bow compelling. So we think it's cheap, we think the yield's good, and we think the catalyst is right here in front of us. That should happen next month, we think.
Next idea, Agnico Eagle Mines, now one of the world's biggest gold producers.
Well, yes, this is Canada's largest gold miner following their transformational merger with Kirkland Gold in 2022. Shares are almost a pure play on gold. 99% of the revenue comes from gold, 1% from silver. That's in contrast to some of these other polymetallic companies. Company's paid a dividend every year since 1983. The dividend has grown at a 17% compound pace over the last 10 years. It's a sleep well at night kind of company. There's 12 operating mines. They're in Canada, Mexico, Finland, and Australia. Needless to say, those are not high political risk jurisdictions. We like that. We also like the management team. They have a well-deserved reputation among investors for good execution, having hit their production guidance in 9 of the last 10 years and beaten earnings forecasts in 18 of the last 20 years. Dividend yields at about 2.4%, and that's elevated relative to its 10-year average. So it checks all the boxes. Stock's doing well, breaking out to nice new highs, and we're constructive on gold. So good name to own if you're bullish on gold, as we are.
And Microsoft is your final idea here.
And this one is the world's largest company. So the theme is big here among these 3.
What do you mean, the world's biggest market cap, you mean? Or?
It is, yeah.
Wow, okay, yeah.
Yeah, so, and obviously by far and away the largest global software company. 3 big lines of business. The big growth driver for them is intelligent cloud computing, so that's Azure and so on. Personal computing, and then productivity and business processes. So that's things like LinkedIn and Office and what have you. So it's a scale advantaged defensive growth company. It's got great exposure to several secular infotech themes that are going to have a long runway in front of them. Digital transformation, cloud computing, business analytics, intelligence, and of course, who can forget AI, where they're a leader, and security and collaboration as well. 70% of the revenues close to are recurring, so it gives them good visibility. A lot of the product offering is mission critical, and we foresee earnings growing at a 17% compound pace over the next 3 years. The stock isn't cheap, trading at 31 times earnings, but in light of those growth prospects, we do see a very good combination of value and growth in the shares of Microsoft here.